Hello, everyone, and welcome to today's presentation. We have Mr. Murray in the house. Murray, say hi to everybody. Murray, say hi. Say hi. So if you hear somebody barking, it's Mr. Murray. He wasn't supposed to be here today, but he wanted to come to work. Well, anyways, again, let me welcome everyone to today's presentation. We're pleased to have you here. My name is Derek Eichenwald. I'm the CEO and Senior Investment Executive at Triumph Capital Management. I'm confident you will benefit from the information we provide to you today. Thank you all for spending, some time with us, and we're going to jump into some 2001 tax strategies. To help all of you in your note-taking endeavors, what you all have is you have a handout. It are the slides that I'm using today. You can download that. You will all also receive this recording in an email tomorrow, so you can watch it again if you would like to. Anyways, let's dive into stuff, and let's kind of start with some disclosures. So as mentioned before, I'm Derek Eichenwald with Triumph Capital Management. Triumph Capital Management is an independent firm with advisory services offered through Triumph Capital Management. We are a registered investment advisor with the Security and Exchange Commission. The following presentation is not a solicitation to sell you any securities or make any security recommendations. The presentation is really for educational purposes only, and we may hit on some different topics that are in talks inside of the tax code, but are not yet federal regulation or law. So anyways, let's start with how the tax code works. So what you see on your screen right now is this is how the tax code works from the federal level. What you're looking at here is this is a married couple filing jointly. What happens is you go to work, you make money, right? The two of you have a paycheck that comes in, and then you get to take deductions from it. And if you take a standard deduction as married filing jointly, the standard deduction in 2021 is $25,100. Now, sometimes people itemize. Why do folks itemize? If they have interest that they're paying on their home, if they have other types of deductions, so on and so forth, that supersede that standard deduction. In other words, if your itemized deductions total 30 grand, you're not going to take the standard deduction of 25,100. You're going to itemize and take $30,000 of deductions. Anyways, after you take those deductions, what you're left with is your taxable income. And what happens is your first $19,900 is taxed at 10%. Then the dollars that you earn between $19,901 all the way up to $81,000 are taxed at 12%, so on and so forth. I always tell folks all the time, everybody pays the same rate in taxes. What do I mean by that? Me, you, Warren Buffett. It just so happens that a lot of Warren Buffett's income is over $628,000, and therefore a whole bunch of his income is taxed at the federal level of 37%. But Warren Buffett and his wife, they pay 10% on their first $19,900 of earned income, just like everyone else who files married jointly who's on this call or files taxes in the United States of America. Next, let's talk about what are called pref rates. So we just learned about regular tax rates. That's what's on the screen right now. This is just what I just showed you. But then what about that income that you have that comes in from dividends? What about the maybe money that you made by buying a stock and selling a stock at a profit? That type of stuff is taxed at what are considered pref rates. The way that these pref rates work is if your income, and again, this is married filing jointly, if your married filing jointly income is under $80,000, you actually pay no taxes on those dividends and long-term capital gains. If your income is between $80,000 and $500,000, you pay 15%. And if your income's over $500,000, you pay 20%. Now, before we move on, just remember, I'm only covering the federal taxes here. Depending upon what state you live in, your state may have a state tax, and your state tax is on top of the federal tax. Okay, let's keep working here. Okay, so before we dive into today's 8 topics, let's go back in history. So going back in history, the first income tax was proposed in 1814 to help fund the War of 1812. But the tax never happened because of the Treaty of Ghent. And the hostilities kind of died off in 1815, which meant the U.S. no longer needed extra revenue to help fund this war. So the first income tax that went into effect happened after President Lincoln signed the Tax Act of 1862. What this Tax Act did was it set taxes at 3% on incomes above $600 and 5% on incomes above $10,000. However, when we go back and look at the records, they show that very few Americans actually filed tax returns. That kind of happened. There was this very low tax rate, right? This $600 at 3% and 5% above 10 grand. But then the Tax Act of 1864 came into place, and that raised taxes to continue funding the Civil War. Following the Civil War's end, the public began to lose interest in income taxes, and several attempts were made to make the act, go away. There was a lot of complaints, obviously, by business leaders, so on and so forth. And Washington finally said, hey, enough of this stuff. And in 1872, they repealed all the previous tax act. And what they started to do is they said, hey, you know what? We're not going to chase after you. And what they started to do, what the nation started to do for decades after 1872, was a major source of the nation's revenue came in from tariffs, right? The 16th Amendment then went into place in 1913, so like 50 years later. And this gave Congress, the authority to tax American citizens' income. And that's really when this stuff kind of started, is 1913, after, there was some previous acts passed. Tax rates have certainly fluctuated over time, as has the income for the federal government receives from collecting individual income taxes. In fact, through the 30s, income taxes only represented, about 1% of the GDP. They reached as high as 10% as we got into World War II, so in the middle of the 40s. The White House budget estimates that individual income taxes will total 8.3% of the GDP this year, 2021, and actually go up to about 9% by 2025. In the 2019 fiscal year, the United States government collected $1.72 trillion in individual income taxes. As many of you may remember, during the 2020 election, there was much talk about taxes and tax policy. And as we got into it and Biden got elected, so on and so forth. Today on the news, right before we started this, Biden actually made a speech talking about the new Biden tax code. Last week, we did a presentation and we highlighted all the different areas of the Biden tax proposal. This presentation will hit on some of them, but not all of them. You can see that presentation if you visit our website or email us. We're happy to send you off that video. Let's keep working here. So looking at this chart, we can see that the marginal tax rate on top earners has varied over time. In 1915, it was 7%. However, after World War II, the highest marginal tax rate jumped to 94%, as you can see there. It dropped slightly in the years after the war, but it rose again and stayed high through the 50s. Despite being as high as 50% for most of the 80s, it did drop and stay at 28% for 3 years during the late 80s, Reagan administration, before jumping back up to 39.6% in 1993. And then as we got into the 2000s in 2017, we dropped down to 37%. I'm going to show that to you again. And in the Biden tax proposal, it's proposed to go back up to 39. And with that said, even if the Biden tax proposal doesn't pass Congress, in 2007, when they brought down the highest tax bracket from 39.6 to 37, they also brought down corporate rates from 28 to 23. In the Biden proposal, corporate rates will go back up to 28. But inside of those proposals, they all had sunsets. I'm going to show you a graph on the sunsets here in a moment. But just because we were talking about it, I did want to show you this chart. So in the Biden tax proposal, in fact, on my screen on my TV that you all cannot see, I see flashing income rates will not rise for folks making under $400,000. So what in the world does that mean? Again, back on your screen, you can see the married filing jointly 2021 tax brackets. And what you're looking at here is right now, this is how it works. And this is the federal tax bracket. What Biden is talking about doing is taking these three that are on the screen, right, and shooting those up to 39.6. Obviously, what this bracket will do is it'll change to, basically get rid of these two, and then this one would just change to 400,000 and over, 39.6 at the federal level. Okay. As discussed, the U.S. federal tax system is progressive, meaning tax rates increase as your taxable income increases, as already explained and as you saw in the previous slides. The lowest income earners may pay no federal income tax, whereas the highest income earners may pay a significant portion of that $1.7 trillion that was collected. Overall, income taxes cover nearly half of all the federal revenue that comes in. So here's a few did you know. Did you know that Americans who earned more than $200,000 per year, which really represents about 6% of all returns that were filed, they paid over 62% of all federal taxes collected. So again, earners earning over $200,000 a year paid 62% of that $1.7 trillion that was collected last year. Did you know that Americans who earned below $30,000 a year, which represents 40% of all the returns that were filed, paid 1% of the federal income taxes collected last year? And so they paid 1% of that $1.7 trillion. And Americans who earn more than $2 million, but under $5 million, paid 7.5% of all federal income taxes collected. So I know we hear about a lot of that stuff on the news. So here's today's agenda, and here's the 8 topics we're going to cover. If you were with us last week, and I kind of started off on some of the Biden stuff, there's not a lot of that in here. However, we will hit about 2 things on that. But today we're going to discuss 8 topics. First, we're going to review the current tax rules. Everybody remembers, as I was mentioned earlier, in 2007, they passed the 2007 Tax and Jobs Act, which brought about big sweeping changes to the tax code. Most of those are still in effect today in 2021. However, depending upon how this Biden tax plan goes, the Biden administration tax plan goes, that could change for 2021. Every day, every hour, every minute that goes by, that gets less and less likely. Even if it does pass, those changes probably won't take place until 2020. We're going to cover Roth conversion opportunities in 2021. We're going to discuss a little bit about healthcare laws and your taxes and Social Security. We're going to discuss a little bit about distribution actions, so the way that you receive money out of your investment accounts. We're going to talk a little bit about tax-smart asset allocation. We're going to talk more about gifting and how gifting can be a smart tax type of strategy when it comes to estate planning. We'll talk about treasury securities and other tax-exempt municipals. And finally, we'll talk about how we give assets to charity. We have a lot to cover, so we're going to keep this presentation moving. Obviously, in a webinar type of presentation like this, we don't open up for questions. By the way, in the handouts that you have, on one of the last slides, there's a link. You can schedule a call. You can schedule a go-to-meeting. You can call into the office. We're happy to discuss your situation with you. Again, before we move into these 8 topics, I'm going to keep this all within an hour. We're 15 minutes in, so we got 45 minutes left. And before we jump into it, again, this is meant to be educational. None of these are necessarily recommendations. Everybody's circumstances are certainly different, and the way that this works for you may not work for your cousin. So let's jump into it. We'll start by discussing the current tax rules and some of the new laws that were introduced with the Tax Cut and Job Act of 2007. When I say 2017. When I say 2017, you say, Derek, it's 2021. Yes, I understand that, but all of this stuff was passed in 2017, and so that's why I'm using that terminology. So for the 2021 tax year, the standard deduction, as I already mentioned, is $25,100 for joint filers. It is $18,800 for head of households. And if you're a single person, the standard deduction is $12,550. Those deductions, for some of you might go, hey, those sound pretty big. Yes, in 2007, as part of the tax bill that was passed, basically deductions doubled. Okay. But there was some bad news inside of that, that tax plan that was passed by the Trump administration. One of those bad tax things was the ability to deduct state and local taxes. If you paid to the state of Colorado, where I'm sitting, say $100,000 in state taxes, okay, you were able to deduct that, right, before your income went through that federal bracket that we talked about earlier. With the 2007 passing of the tax bill, which is in effect for 2021, at least for now, you were only allowed to deduct up to $10,000 of the state and local taxes paid against your income for federal filing. The child tax credit stayed at $2,000. And the phase-out increased to $400,000 for married couples. In other words, for every kid that a married couple has, they get a credit, so like a deduction against their income of $2,000. However, if that married couple made over $400,000, they weren't able to take that credit. Also, with the 2017, tax cuts, which is again still in effect today, it did limit deducting mortgage interest for buying, building, improving your home. But it gave, for most people, that went way up to $750,000. So in other words, unless you were, a huge real estate mogul and that type of thing, you're still able to deduct your mortgage interest, although you might not because your standard deduction might be higher. Okay. Let's keep working here. Let's talk about a few other things. There are a few more important items that were introduced in 2017 via the tax cut, but are still in place in 2021. 529 plans. 529 plans are college savings accounts. However, in 2017, 529 plans were eligible to fund elementary school, secondary education. It's critical to remember that depending upon what state you're in, every state, it's very weird, has their own 529 plan. If your state has state taxes, it's possible if you use the correct 529 plan that your contributions into the 529 plan can be state tax deductible. I can't tell you how many times I have new clients come in, they got a 529 plan and they got one from ABC company, and I say to them, hey, we should be using the Colorado approved 529 plan because Colorado state taxes are approximately 5%, and every dollar you put in, you get a $5, 5-cent tax credit, and that's very meaningful. Another thing people should be aware of is you can no longer reverse a Roth IRA conversion. Once you convert to a Roth IRA, there's no going back. Here's something to keep in mind. The adjusted gross income or phase-out range for Roth IRAs has risen in 2021 for single filers and head of households. If those folks make under $125,000 per year, they can contribute to Roth IRAs. If they make over $125,000 a year, they cannot contribute to Roth IRAs. Okay. And for married filing jointly, that range, right, where you can contribute to Roth IRAs, is $198,000. If a married couple makes over $198,000, they cannot contribute to a Roth IRA. And then, there's some other things when it goes into Roth IRAs and traditional IRAs. Sometimes people say, well, if I make over $100,000, I can't contribute to a traditional IRA. That is baloney. You can contribute to a traditional IRA if you make $10 million a year. The question is it tax deductible or not? And if you make over about approximately $100,000 a year and you contribute money to a traditional IRA, it is not tax deductible. So why in the world would you do it? You would say, hey, I'm going to pay taxes twice on this. No, that is not the case. Say you contribute $6,000 to a traditional IRA and you don't get the tax deduction. That money still remains inside of the traditional IRA and it grows tax deferred. Let's say that contribution grows to $100,000 and you go and you cash out that traditional IRA. Well, what was your after-tax contribution? Let's say that after-tax contribution was $6,000. You cash it out at $100,000. What do you owe taxes on? Only $94,000. What you put in comes back to you tax-free. Typically speaking, when you contribute to a pre-tax account, like is what a traditional IRA normally is, right? You stick $6,000 in, you get to take it as a deduction. That $6,000 grows to $100,000. You cash out the $100,000. You pay taxes on the entire $100,000, but you can always contribute to a traditional IRA. The alternative minimum tax exemption increased. In 2021, the exemption for married couples filing jointly increased to $114,600, and the phase-out increased to $1,047,000 on the AMT. The estate tax exemption increased in 2021 to $11.7 million. What in the world does that mean? Let me explain it simply. Let's say you're a single person. If you're a single person, and let's say you have one kid, you are allowed to die with, in 2021, $11.7 million. I shouldn't say allowed to die with, but it's the amount of money that you will give to your child that will not be taxed at the estate tax level. In other words, if you're worth, let's say, $20 million, and that all goes to your kid, $11.7 million of it goes to your child, no estate taxes. The remaining $8.3 million goes to your child, and they will pay the first level of taxes, being estate taxes. They will pay right now, the way that the tax code works, 40% against that $8.3 million in estate taxes. Okay? Now, people say, oh, yeah, that's it. That's all they'd have to pay. That's a lot of dough, right? About $4 million. But let's say some of those assets are also retirement accounts, such as an IRA. Well, even though you got hit with the estate taxes, okay, now your kid ended up, right, with the whatever $15 million. And let's say out of that $15 million, I don't know, $5 million is in an IRA. Well, when your child goes to go take that money out of that traditional IRA or that pre-tax retirement account, they're going to pay taxes on it again. Okay. Just as a side note, again, it's not part of this presentation, but inside of the Biden tax proposal, that $11.7 million is scheduled to come down to $3.5 million. And the tax rate on all the dollars above $3.5 million is going from 40 to 45. Now I know I said is going. Remember, this is pending Congress's approval, if you will, or vote. So we'll see what happens there, but that's what's scheduled to happen. Okay. But with all this said, right, and to stay within the 10-year budget of $1.5 trillion, lawmakers scheduled many of the 2017 tax laws to expire. Some of the key provisions expired in 2018, others in 19. Well, a whole bunch of them are set to expire in 2025. And so when I say expire, right, remember 2017 Trump tax cuts. But when they passed these Trump tax cuts, as you can see on my screen, they all, not all of them, but a lot of them expired in 2025. And what I mean by expired is they would go back to where they were prior to the 2017 tax bill being passed. Now, two of those things that were going to go on forever was the corporate tax rate, because, arguably for years we've had the highest corporate tax rate, on the planet, and business leaders, so on and so forth, have complained about that. So one thing that passed in 2017 was extending that corporate tax rate from 28 down to 23 for perpetuity. Biden again was just on TV, said, "Hey, we're taking that thing back. Pushing it back up to 28 from where it is." I think I messed up what I said there, but you catch my drift. The other thing, it was the repeal on the alimony deduction. And so what happens is if somebody is paying an X alimony, if you thought about it, right? Like, let's just say you pay 50% in taxes, and let's say you're paying alimony. Well, heck, let's say you're paying alimony of $50,000 a year. You had to earn $100,000 to even have the $50,000 in your pocket in order to pay your ex-spouse that, right? So what they allowed you to do is say, hey, you can deduct that alimony from your earned income, right? And we'll see where that goes. It wasn't really inside of the Biden tax proposal. By the way, back to the Biden tax proposal, you're not going to hear it called the Biden tax proposal. It will be called the infrastructure bill. This whole Biden tax proposal is baked into the infrastructure bill. So you'll hear on the news over the next few weeks the infrastructure bill for $2 trillion, and what's inside of there is all of these tax changes that I'm discussing. Okay. Earlier, I showed you a chart on pref rates, right? And so again, what I mean by pref rates is if you get dividends from income, or you bought a stock at 10, sell it for 12, you have a capital gain of $2 on each share, how's that taxed? So if we look again at how investment income is taxed, on this chart, we're focusing on long-term capital gains and dividends. The highest earning taxpayers, as you can see here, pay 20% tax rate on long-term capital gains. Those in the lower tax brackets pay either 15 or 0. Again, remember, what's added on top of these is state tax rates if you live in a state that has state taxes, okay? But one question that you may have is, what in the world are long-term gains? So all a long-term gain is when you hold a security. When I say a security, that could be a stock, that could be a bond, that could be a piece of real estate, any type of capital asset that you buy, and now you're going to sell. It becomes subject to these lower tax rates, these pref tax rates, if you've held on to it for a year and a day, so 12 months and a day, okay? And what happens if you don't hold on to it for more than a year and a day? Let's say you bought a stock or whatever, for $10 and, it's up 20%, it's up $2, I don't know, a week later, and you sell it. Well, that's short term, and short term is subject to ordinary income tax rates. So it's included in those larger numbers, that other chart that I showed you before. It's just not included in the pref tax rate. Okay, so really it's any asset that you've held less than a year. And then you'll see this thing, and it might confuse you, right? And it says qualified dividends or non-qualified dividends, right? So what's a qualified dividend? Well, qualified dividends are produced by companies that meet certain criteria. Generally speaking, the litmus test is, hey, does that corporation file taxes or pay taxes in the United States of America? If they do, typically speaking, those dividends that you get are qualified and therefore subject to the pref rates. Now, let's say you own a German-based company, and that German-based company is paying you dividends. Is that necessarily not a qualified dividend and therefore a non-qualified dividend? And if a non-qualified dividend, subject to those higher regular ordinary income tax rates? Not necessarily. There's plenty of multinational companies outside of the United States that still produce to U.S. shareholders qualified dividends. Okay. And so, this, at least right now, is remaining. Inside of the Biden tax proposal, just so that everybody knows, what they're talking about is for income earners over 400 grand, married, filing jointly, I believe 400 grand, taking this top rate of 20% and pushing it to the highest ordinary income tax rate of 39.6. I think that one's going to have a tough time passing. I think you're going to see that kind of change a little bit. All right, so let's keep working. One way to manage investment-related taxes is to consider taking advantage of tax-deferred accounts. And so such, tax-deferred accounts are things like 401ks, IRAs, annuities, health savings accounts. These types of accounts have the potential for tax-deferred growth. In other words, money goes in, you may even get a tax deduction for putting it in, and then once it's in there, it's growing tax-deferred, okay? You may also be able to manage your tax liabilities by revisiting your asset allocation strategy and shifting your investments to assets that generate tax-exempt income. For example, municipal bonds are exempt from federal tax. Municipal bonds may also be free of state tax if you own the municipal bond in which the state that you live. In other words, if you lived in the state of Colorado and you bought DIA bonds, let's say municipal bonds, and you got interest from those municipal bonds, you don't pay state taxes and you don't pay federal taxes on municipal bonds. However, if you owned a muni bond issued in the state of California, you would still pay Colorado income taxes on it, but you would still avoid federal income taxes on it. It's important to remember that any investment strategy should reflect your goals, your risk tolerance, your timeline, and as important as taxes are, they should only be one of the factors to consider when creating an investment strategy, obviously. We mentioned a few other specific products as we intend the topic of managing investment-related income. It's really not to suggest these things. It's really just, again, educational in the tax realm. There's some other things you should keep in mind, right? And those other things that you keep in mind when we're talking about qualified accounts, 401ks, IRAs, so on and so forth. Pre-tax accounts, money that goes in pre-tax, grows tax deferred, are subject to RMDs. RMD stands for Required Minimum Distribution. The way in which that works is in the year that you turn age 72, depending upon your account balance on December 31st of every year, your age, then what happens is it goes through this calculation and it says, hey, here's how much money you have to take out. And the reason why you have to take it out is the government's looking to collect their income on it. And so that is what RMD does. Annuities do allow you to deposit money, unlimited amount of money. They do allow you to grow that money tax deferred. When you take that money out of an annuity, just like taking it out of an IRA, it is taxable income subject to those higher tax rates. But there can be tax benefits with them. And there's plenty of problems with annuities as well. Don't get me wrong. I'm simply bringing up the product because it allows for the tax deferred growth. And then inside of health savings accounts, today often you can not only put money into a health savings account, but you can invest that money inside of the health savings account. With that said, if you're spending the money out of the health savings account, so on and so forth, you may not want to invest it inside of there. But the health savings account can do two things for you. One, give you a deduction, and then two, it provides for tax-free growth, very similar to a Roth. When you take the money out of the health savings account, as long as it's used for medical expenses, you got the deduction on the way in, you can invest it, gross tax-free, take the money out to pay for medical expenses, and it's tax-free on the way out. What happens if you get to age 65? You qualify for Medicare, but you got $500,000 sitting in an HSA account. Well, at age 65, if that money's still sitting in your HSA account, now really because you qualify for Medicare, you kind of got expenses paid for, you can actually roll that health savings account over into a Roth IRA if you have a balance at the end of the year. So personally, every year I max out my health savings account. Hopefully when I get to age 65, I got a big honking balance and it's just another retirement account. But these are all different things to consider. Just to kind of give everybody the limits, in a 401k plan, if you're under the age of 50, you can contribute $19,500. If you're over the age of 50, you get a catch-up provision, so you can put in $26,000. You can see the IRAs. That goes for both traditional and Roth IRAs. Under the age of 50, $6,000. Over the age of 50, $7,000. You see the catch-up number there. Earlier, I made a comment and I said, hey, if you make over X amount of dollars, you cannot contribute money to a Roth IRA. But there's a whole concept called backdoor Roth IRA. It's something that I actually do personally every single year. In other words, I contribute my $6,000 into my traditional IRA, and I then immediately convert it to a Roth IRA. And by doing that, because I didn't get a deduction on the way into the traditional IRA, so I didn't get the deduction, when I go to convert it to the Roth, I don't owe any taxes. Now, there's a lot more to do with that, but that's just a little tidbit. We got to keep moving here because we got just shy of 20 minutes left, and we got a lot of slides to cover. So let's keep working here. Okay. Now, we'll see slight changes to the IRA deduction limits and Roth IRA cutoffs. Every year that kind of changes, so on and so forth. We'll see if that kind of changes with the Biden tax proposal, so on and so forth. But again, earlier I mentioned, if you make over certain income levels, so on and so forth, you get phased out. In other words, you can't contribute. There's all different types of ways around that to kind of speed up the presentation here. Backdoor Roth IRAs, after-tax traditional IRAs, that type of thing. Again, if you give us a buzz, we can discuss your personal situation and see if any of that stuff works for you. Okay. So let's keep working here. Let's move on to Roth conversions. So we've covered some of the highlights of the current tax law. Let's move on to Roth conversions and let's chat about them. Well, Roth conversions are not necessarily right for everyone. It does provide advantages for some investors. In a Roth conversion, you may withdraw money from a traditional IRA to pay the federal and state taxes due and move the funds into a Roth IRA. The thing is, inside of a Roth IRA, all future growth and withdrawals are tax-free, okay? Roths also don't have a required minimum distribution, which can play a role in an estate planning strategy. And so you may think, why in the world would I do that? Well, if you're doing your financial planning right, you may find like, hey, look, I have all this excess cash. I'm probably not going to need a whole bunch of it in whatever's excess. I'm not going to need that excess in my retirement years. We run Monte Carlo simulations to help determine that, so on and so forth. And okay, well, geez, maybe what I'll do is I'll convert some of that traditional IRA, pay the taxes today, right? And then it's all free from there on out. So why would you pay the taxes today? From an estate planning standpoint, one may argue estate taxes will go up. So if you did it today in 2021, we kind of know taxes are going up in 2022, right? But where will taxes be in 2052, right? They might be a heck of a lot higher. So maybe you'll pay the tax burden today, right? But you don't want to do that with, it needs to be thought about very specifically inside of a plan if it makes sense. Okay. There are some considerations when converting traditional IRAs to Roth IRAs, and again, as I mentioned, those all need to be discussed with your personal situation, right? But it's something that people should be aware of. It's something you can do. It's something that should be thought about. It's something that should be baked into your plan, if you will. Let's keep going, and let's chat about giving to charity. So if you're planning to give to charity, this is very important. One very tax-efficient way to do so is by donating appreciated assets. In other words, like this, you're going to give a donation to a charity, and let's say every year you donate 20 grand. You might write a check for $20,000, right? If you write that check to a qualified charity, okay, you get a tax deduction for it, right? Now, pretend you bought a stock for 5 grand, and today the stock's worth 20 grand, okay? It's over a year, okay? If you sell that, you owe taxes on the $15,000 worth of growth. However, instead of writing a check to the charity for $20,000, give them the stock that's worth $20,000. Why? You still get the deduction for $20,000, plus you get to avoid paying the capital gains tax on the $15,000 in growth. And so giving appreciated assets, that could be a mutual fund, that could be a stock, that could be anything, any appreciated asset, piece of real estate, whatever the case may be. Another thing that's super important, because this comes up all the time, married couples, 75 years old, have IRAs, have to take RMDs. Let's say, okay, that RMD, by the way, that's part of their taxable income, right? But they don't really have any deductions. They're taking the stand, like the house is paid off. They don't have they don't have kids anymore, that type of thing. They're taking the standard deduction of the $25,100. Their RMD, let's say their RMD is the husband's 10 grand, the wife's is 10 grand. These people are charitably inclined, okay? So they write the check for 20 grand. Well, they don't even get the deduction, right? Because they're taking the standard, right? They took $25,100. It's not as if they get $40,500 and the RMD was included in their income. So how can you make it so that the RMD is not included in your income? There's a whole bunch of ways, by the way. However, from a gifting to charity, what you're allowed to do, this was all part of the tax code. You can gift directly from your IRA. If you gift directly from your IRA, that RMD amount, like let's say I say to you, hey, your RMD is 10 grand. And you go, okay, but you write the check from your IRA and give it to a charity, then that 10 grand isn't going to show up as part of your earned income. So you can gift directly from a traditional IRA, in a 401k account, that type of thing. Very important, because on the flip side of that coin, the husband and wife got the 20 grand in RMDs. They then wrote the check for 20,000. It didn't matter. They didn't get the deduction, right? Because they took their standard. They didn't itemize. Their only itemized was a $20,000 charity, right? So in the separate way, they still took the $25,000 standard, but they didn't recognize the income from the RMD. Again, other ways to tax shelter RMD, but this is just one way gifting to charity, and you can gift directly from your IRA. A lot of people don't know that. Okay, let's move on. Healthcare and Social Security laws and taxes. Okay, first thing that you have on your screen. A lot of people don't realize this. You go to work for a company. If you notice here on the screen, I got 2017 Social Security wage-based, 127 grand. You see that, and now you see 2021, $142,800. Here's what happens with Social Security. You go to work for a company, let's say you work for Google. Let's say Google pays you 250 grand a year, okay? Well, what happens is on your first $142,800 of income that you're earning from Google, you pay 6.2% to Social Security. Your employer, being Google, matches that. They put in 6.2% to Social Security. You, as the employee, stop paying Social Security taxes on every dollar that you make over $142,800. For the last 20 years that I've essentially been doing this, people say, Derek, do you think Social Security taxes will be around? And I'll show them this, right? I'll say to them, hey, look, it's 2021. You don't pay any Social Security taxes on above 142 grand. Nobody knows that. They go, really? I didn't know that. Well, Congress can fit Social Security really easily. Nobody knows this, so tuck it into the infrastructure bill. I'm not necessarily saying to do that. I know some people on the call, on the webinar today, don't like to hear that, but right, that could have been an easy fix. Now, by the way, Google's paying you $250. Google, the company, has to pay the 6.2% on the entire salary, the entire $250. It's the employee, okay, who got the benefit, right? They didn't pay anything more over 142. Real quick, while I have you, even though this is tax strategies, under the Biden plan, as I mentioned earlier, right, 6.2% on that 142,000. Under the Biden plan, it's kind of bizarre what he's doing. He's kind of doing what I said here, but what he's saying is, look, you'll stop paying as an employee once you hit that $142,800. But then, on every dollar that you make over 400 grand, you're going to pay as the employee 12.4% on every dollar into the Social Security system. Okay? Now, if I go back to my last slide, you maybe noticed here this little thing here that said employee Medicare rate. Let's take a look at where that's going and where it's at today. So, in 2013, two healthcare taxes came onto the books which affected higher income tax payers. Now, when I say higher income tax payers, I don't want everybody to shut down. This will affect, okay, people that make over 125 grand. So I wouldn't necessarily say it's higher income tax payers. But the two laws that came onto the books were the additional Medicare tax and the net investment income tax. Let's start with the Medicare wage tax. So as of 2013, high-wage individuals pay an additional 0.9 on wages above certain thresholds. Who's subject to this additional tax? So who are these people? If you're married and you file federal taxes jointly, you're subject to a 2.35% tax on your combined wages that exceed $250,000. That's a husband and wife. If they earn over 250 grand, 2.35%, as you can see on my screen, disappears, okay, to Medicare tax. Now, if you earn under that number, it's 1.45. Okay. If you're married and you file separate tax returns, then it's at 125 for the two of you. But to give you an example, let's look at a single individual in 2001 with a wage of 240 grand a year. Well, what would happen is they would pay 1.45, as you can see on the screen, on their first 200 grand of income. Then on their next 40 grand of income, because remember I said this is an individual person, they make 240 grand. On that additional $40,000 of income, they would pay 2.35 in the Medicare tax. Now, some of you on the call, it's kind of the middle of the day. You might say, well, I don't go to work. I don't earn income. This doesn't affect me. Well, let's jump to the net investment income tax, okay? What happens here is the second bill that was passed in 2013 is how Medicare affects investment income. So if you're going, hey, I just sit back, I got money coming in from social, I got to take money out of my IRA, and I got an investment account where I got dividends and so on and so forth, this can affect you. So this is known, as the Medicare tax or the unearned income tax. So before 2013, you didn't have to pay Medicare tax on investment income. With the net investment income tax, however, certain high-earning individuals have to pay an additional 3.8% tax on income received through their investments. People who have to pay this tax include individuals whose modified adjusted gross income is above $200,000 a year. People who are married people who are married and file individually with AGIs above $125,000 a year. And for couples, if you're a couple, most people I think on the call married, right? You're filing a joint tax return. If your AGI is above $250,000, okay, then you're subject to paying this additional 3.8 in Medicare tax or Obamacare tax. This tax applies to many types of investment income, including dividends, capital gains, rents, royalties, non-qualified annuity income, business income, or any other income that's considered passive. In other words, you're not going to work today for it. The tax does not include, however, retirement plan contributions, so the money that you're grabbing out of your IRA, Social Security benefits, and pension benefits. But let me unravel this for you, okay? So if you think about it, let's say you got a retiree. The husband and wife are bringing in 70 grand from Social Security, 60 grand, 70 grand from Social Security, right? They then take extra money out of their IRAs, right? Retirement accounts, what have you. Then they got an investment account. They don't even touch it, but it produces dividends, so on and so forth. Well, you add all of those together, right? You add all those together. So look at your tax return. What was your AGI? If you're married filing jointly and your AGI is over 250, all of those income sources go to count towards the 250. Well, if your AGI is over 250, then all of that dividend income, long-term capital gain income that had those pref rates, tack another 3.8 onto it from Medicare tax as an FYI. Okay? All right. So if you spend relatively large amounts of money on health-related services, you may be able to deduct those expenses from your taxes. For 2021, you can deduct medical, dental, and other healthcare expenses that exceed 7.5% of your adjusted income. These expenses include those associated with diagnosing, treating, preventing diseases, such as prescription drugs, some insurance premiums, medical equipment, and travel costs to and from the appointments. So if you're somebody who's keeping down your AGI, because there's ways you can keep down your AGI, but you got medical expenses that you're paying out of pocket and that type of thing, if it's over 7.5, you should really be keeping track of it because it can be deductible, right? You still have to fight against the standard deduction that you might take, but, right, it could be part of your itemized deductions if you got that kind of going on, right? We're going to start moving quick here because we're coming to an end. Distribution actions. Let's look at some details you should consider when taking retirement distributions. So, another way to help you keep more of your hard-earned money is to think about how taxes affect your income strategy. Here are some ways to potentially avoid tax pitfalls when taking distributions. One thing that we do for our clients, we recommend that everybody does, is they inventory all potential sources of retirement income. The list might include retirement accounts and any other accounts that you manage, right? You review those accounts for tax treatment of each item and how a change to your income sources would affect your overall taxable income. An example is if you move money from a taxable account to a tax-deferred account. Also, determine whether you should consider adjusting your asset allocation to move assets into tax-deferred accounts or maximize contributions to reduce your reportable income.
For those of you who own businesses, small business owners, 1099, so on and so forth, I showed you the 401k 19.5 with the catch-up 26. If you own your own business or you're a 1099 person, you can get a lot more than that. We show people all the time how to get north of $250,000 into tax-deferred accounts, okay? But looking at these and then looking at the asset allocation, right? Do you own the right investments in the right type of accounts? I can't tell you how many times I have a new client come in and the guy's got a municipal bond fund inside of his IRA or owns municipal bonds inside of his 401k, this type of thing. By rearranging the way that the investments are managed, we can generally find what we like to refer to as tax alpha, better tax scenario for clients, but very important for you to do, very important to look at how income's coming to you and if you can make adjustments to it, right, from a tax perspective. We kind of hit on this, but tax smart asset allocation or asset location. It shouldn't be confused with asset allocation. Asset allocation is how your money's invested. But when we talk about asset location, it goes back to owning the right investments in the right accounts. It also goes into what we'll talk about next, and that's gift tax exclusions. And so when we're doing planning for couples, right, and they, all of a sudden we start to look at the plan and they have excess cash and that type of thing, typically speaking, we say, hey, how's that money going to transfer? We do the legal aspect of things. So here at Triumph Capital Management, through our legal arm, we do estate planning. And so typically speaking, husband and wife say, hey, here's how the assets are going to transfer. And at the end of the day, a large majority of those assets are going down to their children, right? And so if we recognize excess assets inside of there, we say, hey, why wouldn't we come up with a gifting strategy today? And what in the world does that mean? A gifting strategy says that you can gift $15,000 to as many people as you want to. Literally, you can stand out on the 16th Street Mall with your checkbook and give $15,000 to everybody who walks by. You don't pay taxes on it. They don't pay taxes on it. Okay? So as an example, let's say I had a couple, right, as a client, and they have 3 children. The new parents could give a total of $90,000 a year to their kids. That's $15,000 to each child by both parents. Now, what happens if you gift more than $15,000? People are, I can only gift $15,000. No, that's not. You can gift today. You can gift however amount you want to. You can gift somebody $20 million. So let me tie a bow on this for you. Why do people gift? The first reason why people gift is this. Remember what I said earlier. Today, 2021, you individually pass away with $11.7 million. Every dollar you pass away with over $11.7 million is taxed at the estate level. So people will gift to keep their estate in check. Now remember, the Biden tax proposal is bringing that back down to 3.5. I do think that area will pass, okay? So when you think about it, working with a couple, right, if you look at all the assets, and by the way, it includes all your assets. It includes your investment accounts, your bank accounts, your equity in your home, your vacation accounts, your cufflinks, your vehicles, everything you own. What's the estate worth? Well, right, so if it's over $3.5 million, hey, we might as well start gifting it to the kids today. Now, sometimes people say, I don't want to give it to the kids today. They'll blow it. That's okay. We can gift it into a trust and do crummy letters, and then you can dictate basically at the time of the creation of the trust when they get it. But you can start moving money out of your taxable estate, right? And that's the whole gifting thing. But what if you go and you write a check today for $1 million? Right? What if you write a check today for $1 million? People are like, somebody owes taxes on it. No. All that happens is you can gift $15,000. The $15,000 doesn't eat into your $3.5 million exclusion. What if you wrote a check for $1 million today and you made it as a gift to your kid? Okay? Well, all that would happen is today you can die with 11.7, but let's just pretend it goes back down to 3.5, okay? You just wrote a check to your kid for $1 million. Well, all the dollars over 15,000. Now take your $3.5 million and reduce it. So forget about the 15. It just took your 3.5 and it took it down to 2.5. If you catch my drift, that's what happens when you gift above the 15. But there's all kinds of great ways to do gifting, and there's all types of wonderful conversations to have inside of there. This is huge for everybody. I do want to hit it. The Biden tax proposal will eliminate the step-up in basis. What does this mean, and how does it work? Today, say you own a stock or an asset, piece of real estate, doesn't matter. Bought the stock for $5,000, it's worth $1 million. You pass away. You leave that to your kid. Your kid inherits that at $1 million. Your kid sells it the next day for $1 million. They don't owe any taxes. If you sold it while you were alive, you bought it for $5,000, it's worth $1 million. You now get to pay the taxes on the growth. But a step up in basis happens when you pass away. You cross the marriage line if you're married, so it goes down to your kid. The kid gets a step up in basis. That happens for real estate. That happens for stock. That happens for all capital assets, not retirement plans. You got $1 million in your retirement plan. You leave it to your kid starts taking money out of it. They'll pay taxes on the money that comes out of it. The Biden tax plan is calling to eliminate the step up in basis. Okay, so either the beneficiary, your kid, would now have to pay the taxes on the right. You paid $5,000 for the stock; it's worth $1 million. They'll be subject to the taxes, or the deceased estate will have to pay for those taxes. Probably the deceased estate, because dead people don't vote. Treasury securities and tax-exempt municipals. Most of you know this, but depending upon where your tax rate is, depending upon the income, so on and so forth, holding such things like treasuries and municipal bonds, right, can generate tax-efficient income, if you will. And it can be very comparable to the taxable income once you do a calculation that goes, hey, look, based upon your tax rate, if you were getting like if you look at it, you go, hey, I go and buy a regular bond, it pays 6%. I look at a municipal bond, it pays 3.5. Right off the bat, people go, hey, I like 6% better, right? And I go, well, it depends upon your tax rate. If you go 1 minus your tax rate, right, and then divide that by 100, you come up with your tax efficient yield. And so if your tax efficient yield, let's say that comes out to 3.2, you're better off owning a tax-free at 3.2 than a taxable at 6, if that makes sense to everybody. One other thing that I didn't mention in the tax allocation, tax alpha, let me throw this at everybody. Have an investor. The investor likes, let's just say, oil and gas. We're going to call them Investor A, Investor B. Investor A, January 1st of the year, puts $100,000 into an oil and gas company. We'll call it ExxonMobil. Investor B puts $100,000 into an oil and gas company. We're going to call that one ExxonMobil. Come June of that year, both of these investors' $100,000 investment is now worth $90,000, right? However, January 1st of the preceding year, both of their accounts are worth $110,000. Who did better? You'd say they did the same thing. They both worth $110,000. However, Investor A, let's say Investor A, when their value, their $100,000 that they invested, is now worth $90,000. Let's say they sold ExxonMobil, but they still liked oil. They would have held, but they still liked oil. So they took their $90,000 and they bought BP, British Petroleum, right? Investor B just he was doing so well. Investor B just held on to their ExxonMobil. And again, at the end of the year, Investor A worth 110, but it's in BP stock. Investor B's worth 110, but it's all in ExxonMobil. Who did better? Well, Investor A, they sold, took a $10,000 loss, right? They took a $10,000 loss. They got to claim that loss. They now sold when they had a $10,000 gain. They washed each other. Investor A kept all $10,000 of their growth. Investor B, who just remained in ExxonMobil, right, 110, they sold. Let's just say that was subject to the capital gains rates, blah, 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 blah. Let's just say they paid 20%. They're actually worth 108 after taxes. So doing tax harvesting inside of taxable accounts is very efficient and something that should absolutely be done for you. Holding tax-free types of securities, so absolutely be considered, based upon your situation in both instances. All right. We talked about giving appreciated assets to charity. Now, people say all the time, well, I give appreciated asset to my son or to my daughter or whatever the case may be. I just wanted to clarify that with this slide. And by the way, we're done. But when you get a tax deduction, it has to be to a qualified charity. You're giving a gift in both instances, whether it goes to your son, your daughter, or a qualified charity. But qualified charities are the ones whom get the tax deduction. Your gift to your heirs, if you will, or to a trust on the benefit of your heirs, that doesn't get a tax deduction. That's an estate planning strategy to help control the growth of your estate, if that's a concern. Anyways, how we help. Obviously, as you guys know, we analyze your needs and your goals. We then, from there, help select suitable investments. We set realistic performance expectations. We monitor the portfolio, recommend changes over time, and all of this tax stuff gets baked into it. It doesn't show up in performance reports. Nobody at the end of the year says, Derek, what was my after-tax adjusted return? Back to those two investors, A and B, they both accounts were worth 110, even though investor A actually did better after tax. A performance report's still going to say that they're up 10%. But as you can see, the reality is one investor was up 8%, the other investor was up 10%. Once you take taxes into consideration. So certainly something to do. In your handouts, if you come to this screen, if you'd like to set up a time to chat, you can click on that button and a calendar will come up. You can also set up a go-to-meeting if stuff like that is needed. If you head to our website, we have future educational webinars as well as historical educational webinars. Throughout today's presentation, I did make some comments about the proposed Biden tax plan, which we did last week. You, if you head to our website, or email us, can get a copy of that in video format as well as PDF. And you can also register for future educational webinars. We have our State of the Markets coming up. I believe in a week or two. And then, once this Biden tax plan or the infrastructure bill does get passed and some of the stuff gets kind of worked out in Congress, we'll obviously have an update to these things. But it does look like some sweeping tax reform will be coming into play either for 2021. I hope not, because it kind of catch a lot of people off guard. But definitely for 2022. Now, you may go, well, look, I got a CPA, they deal with it. Your CPA is not going to be dealing with 2022 until 2023. CPA is always backwards looking. I shouldn't say that. Some people, CPAs may be meeting with you and doing some tax planning in advance. But with that said, right, typically speaking, hey, give me all your tax stuff. What did you do over the last tax year? So you got to do this stuff proactively as opposed to retroactively. We're here to help. Give us a buzz. Let us know how we can help, and we look forward to hearing from you all. As always, thank you. And again, just to kind of end the presentation on a compliance note, again, nothing today should be taken as investment advice. Nothing today should be taken truly as even tax advice. This was educational. It was kind of designed as a 50,000-foot overview to just kind of wet your lips with, what's going on inside of the tax code, what's going on today, perhaps some things that you may want to think about, should be aware of, and may take advantage of. So again, we thank you all for spending an hour with us, and we really appreciate your time. Thanks so much, and have a wonderful day, and I'm signing off. Have a good evening. Bye-bye.